Hello and welcome. This is KYC. I'm Agam Vakil, and in this show, we take a look at one particular stock every single day, and we talk about how it's done in the past and what we can expect going forward. We try to get in a street view and also try and assess, the outlook of these companies, keeping in mind what the management could say. Of course, in terms of today, we're going to talk about ONGC. This is one of the most widely held stocks as far as the markets are concerned. Been a part of the Sensex, been a part of the Nifty, and anyone who's been in the markets for decades and decades, well, they will be well versed with what ONGC is all about. It is the largest crude oil and natural gas company in India, certainly the biggest in the PSU space, and well, it's an upstream company, so that's the other thing that we need to keep in our mind. It does explore and produces oil and gas, oil specifically, crude, that is what we can keep in mind. Of course, it's contributor to over 70% of Indian domestic crude production, and it does have plenty of exploration sites out there offshore particularly. But moving on, let's just talk about a handful of other factors that we are going to talk about as far as ONGC is concerned. ONGC in general, of course, as I've mentioned, is a very widely tracked stock. It's a very well-held stock. Well over 28 lakh investors hold ONGC at this point in time. And of course, it's one of the relatively larger holdings of the government of India as well. Well, in every show, what we intend to do is talk about a handful of parameters, and we actually rate these companies based on the parameters, which would include something like your income statement, your balance sheet, your cash flows, return ratios. We're also going to talk about cash flows, shareholding, street credentials, as well as street coverage, and give the company a sort of rating in terms of how it's done in the past. And then we try to look forward by bringing in a street view and perhaps talking to experts about what we can expect going forward. But before we do that, let's also get in my colleague Mihika, who's going to give us a better idea of how this could potentially be. Well, I'm going to start off with the income statement and, in terms of how that things could potentially pan out as far as the income statement is concerned. So, in terms of the standalone numbers, and the reason why we're using standalone numbers is because it does have ownership on several other companies, and it would be perhaps fairer to give you the best view as far as the standalone, standpoint is concerned. So you do have revenues which have risen by around 12% or CAGR. Do remember that this is a large cap company, and it's a very well-established company which has been around for decades, as I mentioned, which is why a double-digit growth is reasonably positive for the company. It's in terms of its EBITDA too, it's seen about a 13% CAGR over the last 3 years. Net profit has not been growing to the tune of your revenue and EBITDA, but there is a lot that comes through between EBITDA and the bottom line. So that's something that we need to keep in mind. As far as those operations are concerned, we do see that improvement coming through, and in fact its margins have gained about 150 basis points over FY22, FY24. Let's move on and talk about the other factors as well, and of course I'm going to also address how we are potentially looking at the balance sheet coming through. So when it comes to the balance sheet, it has a significantly large equity, as you can see on your screen there. And the reason, of course, is, decades and decades of accumulated profit. This is, of course, after dividends being doled out, and that's where we're starting to see this come through. Based on that, we're looking at, a relatively low debt, and a lot of that will, of course, be on account of just working capital largely and, near-term expansion. And of course, cash equivalents will be at a reasonable level. And if you just compare the cash levels and the debt level, you know that the debt is negligible. It's certainly not as large as what one might take, and especially given the equity. It's nothing compared to that. So that's of course always going to be a positive, which is why we'll give this one a thumbs up. But let's move on and talk about a handful of other parameters too. So I'll get in my colleague Mihika to tell us a little bit more about the cash flows as well. Mika, what are you observing here?
Yeah, first I'll talk about the production and their guidance, their cash flows will be dependent. Anything that ONGC earns, you can basically divide it into two parts. One is your production, one is your realizations. So when you talk about your production, crude oil, FY19 stood at 21.1 million metric ton. You have FY24, 19.5. You can see the decline, 6-year CAGR. Production, crude oil production has fallen 2% from a 6-year basin. It has consistently been falling over the past decade. In terms of your natural gas as well, 24.8 billion cubic meters in FY19. FY24 stood at 20 BCM. It's a 4% CAGR degrowth. And even if you talk about your total production for ONGC, which is your crude oil and natural gas, it has declined at a 3.8% CAGR over FY19 to FY24. When you talk about their guidance, well, ONGC has managed to miss all of its production, crude oil production targets for the last 6 years. It has consistently done to do so, and you can also see the decline in their overall guidance as a whole as well. And in terms of your natural gas, guidance has been met 2 out of the past 6 years. So that is something that you could is a little cautious. You've seen your production declines because of maturing fields and delays in execution of new assets, and you've seen your crude oil and gas production not meeting to what was expected and hence missing it. So it's a thumbs down on this one. The next parameter I want to talk about is return ratios. 2021 we saw return ratios both in terms of your return on common equity and return of capital employed on single-digit numbers, if I could get that on the screen. 2022, we saw that certain uptick. Okay, 2023, we saw your return on equity as well as your return on capital employed kind of stabilize, but 2024 has seen an uptick. So 2022 could be a outlier since you see the kind of jump it takes, but we have seen it stabilize and now seen an uptick in the last year that was relevant for the company. So it's a thumbs up in terms of your return ratios. But Agam, how are cash flows, looking like?
Right. Well, if you consider the cash flows, and naturally on expected lines, cash flows from operations are a huge positive. In fact, if you consider FY24, sure, the cash flows from operations have been lower as compared to FY23, but that also again depends from year to year. As long as it's a positive number, that's what matters. Even in terms of your net cash flows, and this is on a standalone basis, it's a positive because on an overall basis, your net outflow is negligible, next to nothing at all. So I wouldn't necessarily, be too perturbed about that. Now we must remember that you have cash outflows to a certain extent on a net basis. This is after involving payments for property, plant and equipment. You also have exploratory and development, drilling costs coming through, repayment of non-current borrowing, and of course dividend. And after all of that, you're looking at a negligible outflow, which of course means that all in all it's certainly a positive number overall, which is why we're going to give this one a thumbs up too. So that's as far as your statements are concerned. Now we've spoken about your revenue, balance sheet, return ratios, the outlook of course, and of course cash flows. Let's talk about the shareholding, and ONGC is a well-held company. So if you just consider the government of India, it has a majority share, around 59%. Well, FIIs and DIIs have a significant holding in, ONGC as well. Sure, one might argue that to a certain extent this is because of ETFs, which are expected to hold because, of course, it's a part of the Nifty and the Sensex. But even besides that, we have GAIL and IOCL, which are the other two government concerns, who also hold a 10% totally. That leaves about 3.5% only with the outstanding. But even this 3.5% does mean that it has a substantially large shareholder base. So, there are plenty of shareholders out there who, in fact, have this holding. But that's as far as shareholding is concerned. Meega, how has the stock done?
Yeah. Just a fun fact that in your institutional holdings, LIC is also a shareholder for ONGC, so you have your domestic institutions there. But up first, next we'll talk about the street cred. 5-year share performance, the stock has just more than double, 104%. 1-year share performance, stock has seen very volatile movement throughout the past 1 year. You look at it's a 9.5% uptick. So in terms of it has underperformed the Nifty when you talk about your 5-year share performance. Something that does stand out is an your dividend payout. FY24 dividend payout ratio stood at 31.3%. So it's a large chunk of the company's net profits that they are giving to their shareholders. But it is to be noted that a large large part of their shareholding is also with the government of India, versus 13.5% in FY21. And even if you get those data points for the last 4 to 5 years, it has consistently increased. It's never seen a dip. So they are giving more of their net profits to their shareholders. It's a neutral on this one because your 5-year share performance may have been better. This year's also been very volatile in terms of stock movement. And then you have your consensus ratings and targets is what the analysts are viewing. Very vast coverage. It has high analyst coverage. It has a total of 30 analysts tracking the stocks, and optimistic view there as well. Consensus, a 12-month target does imply a 23.1% upside potential, but it's key to be noted that the stock has corrected quite a bit, but it has 20 buy calls, 5 hold calls, and 5 sell calls working for the company. So a largely bullish view and some skepticism, which is also warranted. But Agam, in terms of, we'll go to our SWOT analysis, strengths and weaknesses.
Right. So we clearly have a dominant position in the domestic markets. We know about that. It has vast reserves of hydrocarbon reserves, hydrocarbon specifically, and of course we know that that's the bastion. KG Basin specifically in this case is a big asset, and it's seen a ramp up in production. So these are some of the strengths that ONGC is working with. In terms of weaknesses, well, there's declining production in mature fields. But I reckon that most companies in this sector who have been around for a very, very long time will face this particular weakness as well. There is consistent execution delay and cut in guidance as far as new assets are concerned. Now, that's another weakness that does, play a little bit of a headwind as far as ONGC is concerned. And let's not forget, we also have realizations which are dependent on spot markets and fixed pricing, which of course will also not necessarily always bode well when it comes to ONGC. But moving on, Mihika, what about opportunities and threats?
Yeah. So in terms of your opportunities, well, up first you have the 20% premium pricing. Now, this is for their new gas wells. So right now, from the nomination fields of ONGC, it's sold at a fixed price of $6.5 per million metric British thermal unit. But this new gas will receive a 20% premium, automatically increasing their realizations, and analysts expect this to kick in by Q3, Q4 of this year itself. Second is efforts of product enhancement coming through. We've seen multiple orders that ONGC is giving out to the likes of Deep Industries and more to enhance their maturing production. And they also have, investments and JVs via their subsidiary ONGC Green in renewable energy, which could also, on a consolidated front, help with earnings. Something that also works out well for them is currently there's no windfall taxes in play, so it kind of does not cap their crude realizations. But in terms of risks, volatile crude prices, that's the first risk. A month ago, crude prices were trading around $70 to $75. Today, they are about the $80 mark. So in terms of their average realizations, you do see a kind of volatility. Second one is a delayed ramp up in the KG 98-2 asset. Their production guidance for this asset has been cut meaningfully over the past few years. It's been cut 42% and 33% for oil and gas, respectively, since FY18. So that is something that could threaten. We don't know how peak production will play out going forward. And lastly, while windfall taxes are currently not in play, any reinstatement of the windfall taxes if crude prices do hold higher, the government may come and intervene and kind of cap those crude realizations, and it could prevent the company earning more for every barrel of crude sold. So, but Agam, that's where your opportunities and threats are concerned. What's the overall rating?
Right. So let's talk about how things have panned out. So among the parameters that we had, in fact, spoken about, earlier. We've spoken about the income statement, balance sheet, along with production guidance and return ratios. Moving on, we had, cash flows, shareholding, street credentials, and street coverage. And overall, if you consider the thumbs up, for which we've given 1 point, a neutral point will get you a half a point, and a thumbs down will get you 0 points. Well, the total rating comes to 6 out of 8. Now, this actually came as a little bit of surprise to our team, because we were expecting the rating to be lower. But it does seem like in the past, or at least in the recent past, it has done what it could to make sure that it remains at least at equilibrium with the rest of the sector and in general. But on that note, let's get in our experts for today. Well, we have Prabal Sen. He's the Senior Research Analyst for Indian Oil and Gas Sector at ICICI Securities, who joins us on the show. And we also have with us Mr. Narendra Taneja. He's India's leading energy expert who joins us too on the show. Good afternoon to both of you, and thanks for joining in. Mr. Taneja, I'll come to you first. I want your overall assessment of the sector right now as things stand. There are concerns that the relatively mature fields are now seeing lower production. And on the other hand, where there is a little bit of slowness when it comes to, well, exploration going in. What is your assessment of the sector at the moment?
Well, when you look at India's oil and gas sector in general, of course, we have to divide it in upstream, midstream, and downstream. I think you've been talking about upstream so far. When you look at upstream, basically it accounts for roughly 12% of India's oil consumption, and where, as you know, that we have been discussing, that ONGC is the big boy, the oldest and, a very prominent player. Of course, the oldest is Oil India Limited, but it's much smaller in terms of size and scope and everything. But when you look at the overall exploration production landscape in the country, I think these companies are trying their best. We also have a couple of private sector players, some smaller players as well. But the issue is that we are not that blessed in terms of oil and gas, reserves or potential, as for instance, countries in our neighborhood in the Middle East are. So whatever we have, and increasingly we find that, potential is more in deep water and ultra deep water. And that requires a very specialized expertise and technology and, of course, the capex. Because when you drill a well in deep water, ultra deep water, you're talking roughly about anything between $70 million to $100 million per well. It depends, of course, whether it's ultra deep water and the kind of technology that you want to deploy. So, but their ONGC has tried its level best. You talked about the Krishna Godavari deep water production and all that. I think they have done very well together with a collaborator. And now they're also exploring Andaman Nicobar, they're exploring on the West Coast and so forth. So I think a company as a whole, is trying to do its best. They recently entered into a kind of, joint venture with British Petroleum for their oldest field, one of the oldest fields, that's Bombay High. And that's a flagship, but the production has gone down to 128, under 30,000 barrels a day, and they want to bring it up to maybe 300,000, maybe 250,000. It all depends, because there's all in the domain of future. But I think they're trying their best. But at the same time, they have an overseas arm, as you know, ONGC Videsh. They're trying. There are more opportunities now, but they're trying their level best. But overall, when you look at the landscape, we are importing today roughly 88% of our total requirement. But that includes the oil we import, refine, and then export. It includes that. But still, when you look at the overall landscape, I think our dependence on imports is only growing, despite the fact that we are kind of blending with ethanol and everything. But still, because the oil consumption in India is growing at about 3 to 4%.
Yeah.
So therefore, when you look at the overall landscape, I think there are many challenges.
Got it. So it's the landscape is diverse. You have your ups and downs. Probal, I'll come to you. The street has been very optimistic about the KG Basin. Yes, we saw 3 new wells come in. Production has been bumped up to 25,000, barrels per day. Peak production target is for Q4, 45,000. But considering the delays and the guidance cut overall over the past few years, do you think ONGC can actually meet this KG Basin ramp up? Because when you look at your overall guidance, it's never met the crude oil production guidance in the last 6 years.
No, and I think that's an interesting data point, and that's an interesting question. At the end of the day, their credibility has suffered over the last 6 to 7 years. There's no question about it in terms of production guidance not being met. So I think the ultimate test does remain whether the KG Basin actually not only meets its production targets, but also that it results in overall production actually finally growing to the extent that has been guided to earlier. I think the real expectation that all of us really have is that when the oil and gas production from KG 98/2 hits its peak levels, it will finally reverse the last 6-7 year trend of sustained production decline. And I think that is the big hope and the big expectation that we really have. So far, after the few delays after the multiple delays rather, when production has finally started, the ramp up actually has been fairly swift. It has reached about 25,000 barrels. Our understanding is it's probably crossed that level in the third quarter, and they are well on their way to reach 45,000 barrels of oil per day by the end of the fourth quarter. But again, as I said, it really remains to be seen whether this production, once it hits peak, and sort of stays there, does it actually result in net production actually increasing for both oil? Gas, I think it's fairly given that if 6 to 8 MMSCMD is produced, it will result in a net production increase. Oil will be the more interesting one to watch.
Probal, so are you saying there's still a question mark on whether it will meet its crude oil production guidance for FY25, or is there where does your view tilt, on the bullish or the bearish side?
No, I think we always build in a little bit of a buffer, given the size and scale of the company and the kind of projects that they're dealing with. I think, and given the historical track record, we are always a little bit more conservative. We always build in, we are building in a small production increase in this year and a slightly larger one for next year in our base case estimates. But our estimates are definitely lower than what the management has been guiding to, by a few percentage points.
Okay, so lower estimates with management guidance. Mr. Taneja, I'll come to you. Overall, if you see, ONGC has always invested a lot, and maybe it's in new ventures or enhancing its production. But from a sector view, or maybe from an ONGC point of view, do you see capex coming ahead, and ONGC being able to sustain higher capex as we go forward?
Well, it depends on two things. Number one is opportunities, both domestic and overseas, and at the same time, it depends on in exploration sector, if they're investing more in exploration, it all depends on how lucky you are, because increasingly, as I said, you don't have much kind of potential on land. You have to go deeper and deeper into the sea, and that's Bay of Bengal or Andaman Nicobar and the West Coast, etc. So there again, it depends. But to ONGC, when you look at the ONGC history, they've been mainly operating in shallow water or on land. So deep water is a kind of new territory. Ultra deep water is a very, very new territory. So it depends on kind of tie-ups they go for, technology they bring in. But when you go for deep water, ultra deep water, which seems to be the kind of way forward, you have no other option but to invest more, call it capex, call it by any other name. So I think that's what. And secondly, it depends on oil price. I don't see oil prices to go beyond $80 per barrel, $75 on sustained basis, at least in the immediate future. That means that ONGC will have to either borrow more or basically moderate their, capex plans. But if the prices go up, being an upstream company, they are always the frontline beneficiary of the scenario. So it all depends on multiple factors. But as he said, that ONGC has been around for a long time, is one of the largest E&P companies in this part of the world. It has the backing of the government, and the government is pushing for energy independence in terms of oil and gas too, along with, of course, renewables. So there are many challenges. One of the challenges, of course, how do you run the company? It's a state-owned company. It's not it doesn't enjoy the kind of autonomy that other state-owned companies do in Malaysia or in Norway and other parts of the world. So there are many questions. We can't really, when we discuss ONGC, we discuss in ocean. But if you want to just pick up one small part, focus on that, then it's micro. But then it's not that easy.
No, point taken, Mr. Taneja. But let me go back to Prabal. What is your current rating on ONGC? If I'm not mistaken, as per last count, you were still positive. You were bullish on the counter. Is this because of valuations, or do you also see scope for better prospects going ahead?
No, definitely we remain positive. As I said, we continue to believe that, this time around, it will be, for lack of a better word, slightly different in terms of production trends. Valuations continue to remain very, very comfortable. We also believe in terms of realizations. I think it was mentioned earlier in your show that windfall tax reinstatement could cap realizations. But it's important to remember that even at oil realizations of USD 74 to $76 a barrel, that is still about $15 plus higher than the last decade average that they have actually achieved. So that in itself actually provides a lot of leeway in terms of cash flows and return ratios. Secondly, with a lot of legacy gas field production also gradually moving to the premium gas price formula, given that with the new regime that has been put in place, any well interventions, new wells, even on existing fields, will be counted towards incremental gas production, and therefore will be subjected, or be eligible for a 20% higher price than the current formula. So if you look at realizations, those will also continue to improve. And lastly, the contribution of HPCL is something that cannot be ignored in the overall consolidated earnings, which is also very significant.
Sorry to cut you off, we're short on time, but one quick question. Okay, I get that HPCL, you have your new pricing. Right now, windfall tax is not in play. But prices are volatile, windfall taxes can come in any time. HPCL's outlook is also dependent on various factors. ONGC is a standalone. If it misses its production targets even this year, could it be a case for re-rating?
I don't think that this year will probably be something that is going to determine the fate of the company. I think they've always stated that the gas production will basically ramp up from next year. So I think it has to be looked at from a 12 to 18-month perspective. And if they manage to continue to grow and deliver on the production front, even to 50-60% of the guidance, I think the valuations anyways are discounting pretty much any improvement. So we would be very comfortable still being a buyer on the name.
All right. Thank you so much, Prabal, as well as Mr. Taneja, for speaking to us here on NDTV Profit and giving your perspective and insights on ONGC. It's certainly going to be an interesting one to keep an eye on. But on that note, it's a wrap on this edition of KYC, but lots more lined up on the other side. Stay tuned to NDTV Profit.